What if I told you that your savings account is guaranteed to make you poor every single year? That the safe place you keep your emergency fund is actually stealing your purchasing power, while banks profit from what you don't know? Today, we're exposing the biggest scam in personal finance: traditional savings accounts. And I'm going to show you exactly what to do instead to protect and grow your money. Hey everyone, and welcome back to Simple Finance Bytes, where we break down personal finance in plain English for people working toward financial independence and the simple finance way. I'm Ernest, and this is episode 4. If you missed our last episode about the debt snowball method, definitely go back and check that out. We covered why psychology beats math in debt elimination, and it's already helping people get unstuck from debt that's been weighing them down for years. Today, we're talking about something that affects everyone, even people who think they're doing everything right with their money: traditional savings accounts. Here's the uncomfortable truth. If you're keeping your emergency fund or any significant money in a traditional bank savings account, those typically pay 0.01 to 0.05% interest, you're losing money every single day. Not just opportunity cost, but actual purchasing power. This episode is going to change how you think about where you park your cash, and by the end, you'll know exactly where your money should be living instead. Let's start with some math that's going to make you angry if you're currently banking with a traditional institution or a big bank. The numbers don't lie. The average savings account at major banks pays about 0.01 to 0.05% annual interest. I went to check the website of the large bank that I use, and their savings account is in fact paying 0.01% interest on it, which is one of the reasons I don't have a savings account with that bank. But let's say you're using one of those big banks, and let's be generous and say you're getting 0.05% interest. So 5 times what the big bank that I use with a giant blue logo pays. If you have $10,000 in savings, you'll earn about $5 per year in interest. $5. Again, let's rewind that. If you have $10,000 in savings, you'll earn about $5 per year in interest. That's less than a coffee. Meanwhile, inflation over the past decade has averaged around 2 to 3% annually. This year, it's been running even higher. That means your money is losing purchasing power at a rate of 2 to 3% per year while earning virtually nothing. Let's put this in real terms. $10,000 today will have the purchasing power of about $9,700 next year if inflation runs at 3%. Your bank will pay you $5 in interest. The net result? You've lost $295 in purchasing power for keeping your money in a big bank savings account. Now, it's important here to understand what the bank's side of the deal is here, right? While you're earning practically nothing, what are the banks doing with your money? They're lending it out at 7%, 15%, 25%, in some cases 30% interest rates through credit cards, personal loans, and mortgages. Your $10,000 earning you $5 per year could be generating $700 to $2,500 per year for the bank. They're keeping 99% of the profits while giving you table scraps and calling it a service. Now let's understand why banks keep rates low like that. Traditional banks have no incentive to pay you competitive interest rates because they know most people won't switch accounts over a few percentage points. They're counting on your laziness and what you don't know to subsidize their profit margins. They also have physical branches, expensive marketing budgets, and layers of bureaucracy to fund. All those executives got to get all those multi-million-dollar bonuses, right? All of that overhead comes out of the interest they could be paying you, but they're not. And the opportunity cost here is high. Here's what should really make you angry. It's not just about the low interest rates. It's about what the money could be doing instead. That same $10,000 in a high-yield savings account could earn $400 to $500 annually. Over 10 years, the difference between traditional savings and high-yield savings is thousands of dollars. And if you're keeping money you don't need for emergencies in a traditional savings account instead of investing it, the opportunity cost becomes massive over time. If this is hitting home and you're realizing your savings strategy needs work, make sure you're getting all of our latest guidance. Head over to simplefinancebytes.com and sign up for our free monthly newsletter. I share detailed strategies for optimizing your savings, plus step-by-step guides for building wealth through simple finance principles. No fluff, just actionable advice to help you protect and grow your money. So what's the alternative here? High-yield savings accounts that actually pay you reasonable interest rates for parking your cash. High-yield savings accounts currently pay anywhere from, say, 3 to about 5% in annual interest. It just varies because there's different types of high-yield savings accounts and there's different types of banks and credit unions that offer them. So it's a pretty wide range, but just say 3 to 5%. There might be some outliers in either direction, but it's around that. That's 100 times more than traditional savings account in a big bank. Let me repeat that. 100 times more. Your $10,000 earning 4.5% generates $450 per year instead of $5. That's an extra $445 annually for doing absolutely nothing except moving your money to a better institution. Let me use this same example with the current account I use at Capital One online bank. I believe they're at 3.8% last I checked. So if I had $10,000 in that account, which I don't, but if I did, at 3.8%, that's $380 per year they would be paying me in interest instead of the $1 I would be getting out of the big bank that I use for other things. Most high-yield savings accounts are offered by online banks or credit unions that don't have the overhead costs of traditional banks. No expensive branch networks, fewer employees, lower marketing costs, fewer executives that they need to pay millions of dollars to in bonuses. They can pass all of that along as savings to you in the form of higher interest rates. They also compete aggressively for deposits because they need your money to fund their lending operations. Unlike traditional banks that take your deposits for granted, online banks have to offer competitive rates to attract customers. Here's what's important. High-yield savings accounts are just as safe as traditional savings accounts. Most are FDIC insured or NCUA insured up to $250,000 per account, exactly the same as the traditional banks. You're not taking on additional risk by switching to high-yield savings. You're just getting paid fairly for letting someone else use your money. Some of the best high-yield savings accounts come from institutions like American Express, Capital One, SoFi, Ally Bank, Discover Bank, and various credit unions. I actually have high-yield savings accounts from each one of those, as well as one of the credit unions. And that's because I do all this stuff for research for the website and for this podcast. So I have every single one of these I just listed to you. They're all great. None of these are fly-by-night operations. These are legitimate financial institutions that simply operate more efficiently than traditional banks. They are the disruptors in the financial industry. Rates change over time based on federal interest rate policy, but the spread between high yield and traditional savings remains consistent. When rates go up, high yield accounts go up more. When rates go down, they're still significantly better than traditional options. Here's how simple this is. Keep your emergency fund and any cash you need to access, say within the next 2 to 3 years, in a high yield savings instead of a traditional savings. That's it. No complicated strategies, no risk, just better returns on money you're going to keep in cash anyway. Ready to optimize your savings strategy but want personalized guidance? I help people set up their complete cash management system from choosing the right high-yield accounts to determining optimal emergency fund amounts. Visit simplefinancebytes.com to learn about our one-on-one coaching sessions, and don't forget to sign up for that free newsletter while you're there. Now let's get specific about where different types of money should live based on when you need access to it. Your emergency fund should be easily accessible but earning the best interest rate possible. High-yield savings accounts are perfect for this. You want 3 to 6 months of expenses in an account you can access within 1 to 2 business days without penalties. Some people, myself included, split their emergency fund between a local credit union for immediate access and a high-yield online account for better returns. This gives you the best of both worlds, local access for true emergencies and better growth for the bulk of your fund. As mentioned, this is something that I do personally and is included in our Simple Finance system that will be releasing here in a couple of weeks, but it discusses how I break my emergency fund into two places. There's a certain amount that sits at my local credit union. So if there's an emergency where I need true local live branch access, I have that for that initial part of my emergency fund, and then the rest of it is online. Whenever I need that, I can ACH transfer it to my local credit union and use it as needed. Money you're saving for goals within the next 2 to 3 years should also be in high yield savings. This includes things like a car down payment or a car fund, which I recommend in lieu of the down payment, just pay the car cash, vacation fund, or home improvement projects. You don't want this money in investments because you need it to be there when you need it, regardless of what the stock market is doing. But you also don't want it earning nothing in a traditional savings account. Many people need a small amount of money in their checking account for monthly cash flow management. This might be 1 to 2 months of expenses to handle the timing differences between when bills are due and when paychecks arrive. This money can stay in a credit union checking account or high yield checking if you can find one. We do have options we can recommend for this on our one-on-one coaching sessions if you're interested in also having a high yield checking option or a high yield option that is similar to checking. The key is to minimize how much you keep here, since checking accounts typically pay lower rates than savings accounts. And again, that's a typically. There is an advanced strategy here. Again, it's part of one of our one-on-one coaching sessions. We're happy to go over that with you. But generally speaking, checking accounts pay lower than savings accounts. So you don't want to have too much in your checking account, just enough to cover 1.5, maybe 2 months of expenses, to have that buffer in case something happens, your paycheck gets delayed or something along those lines. You need that little buffer there for security. Here's what should not be in any savings account, high yield or otherwise. Money you won't need for more than 3 to 5 years. So here are some specific things. If you're saving for retirement, if you're saving for your kids' college, if you're saving for any other long-term goals, that money should be invested, not sitting in savings, losing purchasing power to inflation. Even a 5% savings account will lose to inflation over time. Long-term, money needs to be working harder than savings accounts can provide, and that's where investments come into play. For people with larger emergency funds, you can consider laddering CDs or certificates of deposit with your high-yield savings. Again, this is a more advanced strategy. You don't need to do this if you want to keep it super simple. Just use the basic high-yield savings account, but keep 2 to 3 months of expenses in immediately accessible high-yield savings. Then put additional months in 6-month or 1-year CDs that typically pay slightly higher rates. When CDs mature, you can reassess whether to renew them or move the money based on rate changes and your financial situation. Again, we can help you with all of this in our one-on-one coaching session should you need it. Set up automatic transfers from your checking account to your high-yield savings so you're consistently building up your cash reserves. Treat your savings like a bill that has to be paid every month. And this is key. One of the things we always talk about here on Simple Finance Bytes is psychology, your mind. Use systems to help you work with your mind, don't work against it. When you bring something like automation into play and you're automatically moving money to your savings account, you don't have to think about it and you don't have to remember. It just happens automatically. That works. That's a system. You want to set up that system for success. Most high-yield accounts allow you to set up multiple savings goals within the same account, so you can track your emergency fund, vacation savings, and other goals separately while earning the same high rate on it. But the key thing here is automate as much as possible. So let's talk about some common mistakes here and how to avoid them. Even when people understand they need better savings rates, they often make mistakes that sabotage their progress. Here are the most common ones. Mistake number 1 is analysis paralysis. And I know I've been guilty of this in the past many times, and I still struggle to this day, but it's just the way my mind works. And so I have to use psychology in my favor, right, as opposed to going against it. So analysis paralysis. People spend weeks researching the perfect high-yield savings account while their money continues earning nothing in a traditional account. The difference between a 4.5% account and a 5% account is minimal compared to the difference between a 0.05% account and either of those other two options. Just pick a well-rated FDIC-insured high-yield savings account or NCUA-insured money market account at a local credit union or online credit union and move your money. You can always switch later if you find something significantly better. However, mistake number 2, chasing promotional rates. Some banks offer high promotional rates for new customers that drop to much lower rates after a few months. Read the fine print and understand what the ongoing rate will be, not just the introductory offer. Now, this one is key because, again, the last thing I said on the previous mistake was you can always switch later if you find something significantly better. Generally speaking, you probably shouldn't switch later unless something is wrong with the institution you're at. Because again, every time you move something, you make this more complicated than it was before. And the idea here is to keep things simple. So if you pick a high yield savings account, and by the way, we're going to have reputable ones listed in this article on our website, as well as in the show notes, just pick one and go. As long as they're FDIC insured and or NCUA insured, you are good. Once you're in that account, stay. There's going to be constant temptation from banks throwing promotions at you saying we're paying more interest. Those are usually not long-term offers. The ones that we're going to list on our website as well as in the show notes here are ones that have kept their rates consistent over time, but they do vary with the federal interest rates. That's another thing to keep in mind. Mistake number 3, keeping too much in savings. High-yield savings accounts are great for emergency funds and short-term goals, but they're terrible for long-term wealth building. Don't let the better interest rates trick you into keeping money in savings that should be invested. If you have more than 6 months of expenses in savings and no major expenses coming up in the next few years, that extra money should probably be invested in index funds for long-term growth. I know some of our viewers and listeners are also entrepreneurs and or self-employed, so your rule may be a little bit different here. I generally advise that if you are self-employed, if you're an entrepreneur, if you're a freelancer, anything like that, you should have around 12 months of expenses. And I know that's a lot of money. I get it. But when your income is irregular like that, you need to be able to withstand several storms in a row because they do happen when you're a small business owner. However, if you're a regular W-2 employee getting a pretty steady paycheck, never assume that that's safe forever. But I think 6 months of expenses is okay in that scenario, and then you can put the rest into investments. Mistake number 4, not updating beneficiaries. This one is incredibly important, and so many people overlook this one. When you open up new accounts, make sure to set up the beneficiaries either as you're opening the account or immediately after you open the account. This ensures your money goes where you want it to go without having to go through probate if something happens to you. I have literally witnessed this happen so many times where beneficiaries were not listed on bank accounts, retirement accounts, whatever it is. All of that went into probate. The state takes their cut because they have to probate the estate, and or there's contesting happening in wills or whatever the case is, and it turns into a complete chaotic event. Don't let that happen. Put beneficiaries on every single one of your accounts. That way, when you finally do exit this earth, things happen the way you intended them to happen, not the way somebody else wants it to happen. That's the most important part here, that it happens the way you want it to happen. Mistake number 5, forgetting about state taxes. This one was one that I experienced myself the first time I moved to California from Texas. Interest from savings accounts is taxable income. If you live in a state with high income taxes, this might influence which accounts you choose or how much you keep in savings versus tax-advantaged investment accounts. This is another one that can get very complicated, and I highly recommend that if you are in a state that has state income tax, you speak to a tax professional licensed in that state about your tax situation. I am not a licensed tax professional. I cannot give you tax advice. However, as someone that lives in a state that has state income tax, I have had to switch my approach in how I handle high yield savings specifically to negate that. And that's by way of U.S. Treasuries. Again, that's something that's a little bit more advanced. We can cover that in our one-on-one coaching sessions if you need it. But most people don't live in states that have income tax, so they'll be okay. But if you are, pay attention to how you're handling your high yield savings, because generally speaking, bank interest is taxable at the state level. And U.S. Treasury interest is not taxable at the state level. That's the key distinction there. Remember that even high-yield savings accounts might not fully protect you from inflation in high inflation environments. This is key to remember. We just went through this a few years ago where inflation, according to the official numbers, peaked at just over 6%. We all know that wasn't true. We all know those numbers were more like 9, 10, 11, 12%. So even in the environment where you had greater than 5% interest coming on these high-yield savings accounts, the inflation rate was 8, 9, 10, 12%, way above that, probably double. So high-yield savings doesn't always protect you from inflation, but in what I'll call normal inflation years, it's perfectly fine. However, that being said, high-yield savings accounts are much better than traditional savings, but they're still primarily about preserving purchasing power, not building wealth. They're just keeping the money you have in the savings account moving with inflation. They're keeping your head above water. They're helping you tread water. They're not building wealth. Real wealth building happens through investing assets that can grow faster than inflation over time. And at the end of the day, the only asset that does that efficiently over the long term is U.S. equities, or just equities in general. So think stocks, or in our case, we recommend broad index funds, but same principle. Those are the ones that are generally the safest, the cheapest to own, and build wealth the best over the long term. The other thing to remember is that interest rates change, especially in response to Federal Reserve policy changes. So set a calendar reminder every 6 months to review your savings account rates and make sure you're still getting competitive returns. When that calendar invite happens, go look at all the other savings accounts that you looked at originally. So for example, let's say you decided, hey, I really like Capital One. I'm going to use their 360 performance savings. By the way, this is not sponsored by Capital One. However, they are on our list of reputable banks that we use. I use them myself. Let's say 6 months from now, I go look and my interest rate is lower than Discover or lower than Ally or SoFi and significantly lower. Whereas before their interest rates were very similar. There might have been a 0.1 or a 0.2% difference between them all, but they were pretty closely clumped together. All of a sudden, the one I'm in is falling behind. Now I want to go figure out what's going on, right? So that's the reason you want to put that calendar invite every 6 months. And you don't need to do it more often than that. This is not something you need to worry about and be looking every day. 6 months is more than enough. Just put it at 6 months, double check, compare it against 2 or 3 other banks from our reputable list. If everything is pretty close, close it out and move on with your life. Would you like a complete savings optimization strategy tailored to your specific situation? Visit simplefinancebytes.com for detailed guides on high-yield savings, emergency fund planning, and the transition from saving to investing. Sign up for our free monthly newsletter to get updates on the best current rates and strategies, plus learn about our coaching services if you want personalized help setting up your optimal cash management system. Thanks again for hanging out with me today on Simple Finance Bytes. If this episode opened your eyes to how much your traditional savings account has been costing you, you're not alone. I constantly meet people who are shocked to learn they've been essentially paying banks to hold their money while getting nothing in return. Here's what I want you to do right now. First, if this episode helped you understand why savings account optimization matters, share it with someone who's probably making the same mistake with their emergency fund. Second, make sure you're subscribed to the podcast so you don't miss next week's episode. We're talking about investment basics for beginners, specifically how to set up your first investment account and what to actually buy once you have it open. Third, visit simplefinancebytes.com. Explore our savings optimization guides and sign up for that free monthly newsletter. That's where I share the current best rates, strategy updates, and detailed action steps. Remember, the goal isn't to get rich from savings account interest. The goal is to stop losing money unnecessarily while you're building your emergency fund and preparing to invest for real wealth building. Your savings account should be a temporary parking spot for money, not a long-term wealth building strategy. But while your money is parked there, it should at least be working as hard as possible. Until next time, keep it simple, stay focused, and make sure your money is working for you instead of against you.